Well, let us commence. Good morning, everyone. Good evening, good afternoon, depending where you are in our great and wonderful world. Today, what I'm going to do is sort of open it up a little bit. There are two topics, really, in the world economy right now. One, of course, is Europe. And the Europeans have said yet again, and that is counting for almost all of the movement that you're seeing in the various markets this morning, that they have a plan to have a plan, and we'll get the details in 3 weeks. I will say that whatever you want to say about markets and all of their hard-nosed, no, there is no chart here today. What you're looking at, so I'm saying, I'm going to do something a little differently here today. What you're looking at is statistics from Bloomberg Terminal. And that's what I'm going to be focusing on today. But a little background. So there are two topics in the world economy these days, in analysis and markets. First one, of course, the most colorful, the one that's ongoing, the one that has the potential, so they say, to fry the entire world economy is the European debt problem. Greece, Ireland, Portugal, Spain, Italy, and in fact, France and Germany. Because if France and Germany are guaranteeing everyone's debt, then their debt has a problem too. All of the movement we see this morning, there is a holiday here in the States. Yeah, that's right, all the banks passed their stress tests, I know. Those stress tests were such a joke that Saturday Night Live, which, believe it or not, after 40 years is still on TV, should have used them for a comedy routine. But it's a holiday here in the States, it's Columbus Day. So the bond market is closed, but the stock market is open. So you're going to get lighter volume than normal. But you have a very nice risk-on rally this morning. The dollar's down, the euro's up, the equities are up. The bonds would certainly be down were they open. And we have from the Europeans, from Sarkozy and Merkel, a plan to have another plan, details not yet announced, in 3 weeks for the G20. What the markets are assuming here, because the threat has never really been purely Greece, at least over the past several months, the threat has been the European banking system and the effect of a Greek default on the European banking system, but also on the world banking system. It's not like the European banking system exists in a bubble. U.S. banks own their debt. There are lines going back and forth, so it would affect everything. Because the Europeans have been pretending for so long that Greece was not going to default, and the way to handle it was to give Greece enough money to tide it over until its economy recovers. That has been the 2-year plan in Europe. But after 2 years, the markets, the people who might lend money to Greece or anybody else, are simply not buying it. There is no belief that unless Greece defaults, it will ever be able to pay back the debt. It will ever be able to resume normal functioning of their economy, even Greek terms, normal functioning of the economy. It has taken that long for the bulk of markets and analysts to come to this conclusion. I will say some analysts have been saying this from the very beginning, myself among them, that there has only ever been one end or two ends to this problem. Greece defaults or Germany pays for everybody. Germany and France, if you will. That's it. The problem with the first path, Germany and France pay for everyone, which is, although they haven't admitted it, that's the path they've been following. Because when they give Greece money, the purpose is to get Greece functioning. But nothing that they do except prevent the default will get Greece functioning. And they're finally starting to realize that. So it looks like the EU is taking a much harder line on this. Not because they want to, but because there's simply no choice. as again, a number of us have said from the very beginning. There is nothing short of a default that will permit Greece to successfully, even on its own terms, restructure its economy. So that's one topic that we have here. No, I don't think so. I'll be glad to listen. This one I want to do a little bit more open than I do normally, especially when I move to the real topic, which is what is the prognosis for the U.S. economy? Because we have some very strong cross currents in the U.S. economy. We're going to examine some of those. We have a real split between sentiment indicators, both business and consumer, and the actual numbers. And we'll deal with that in a minute. So let's just finish with Europe. So the Europeans have said they have a plan to have a plan. The assumption of the markets now is that what they're doing is preparing to backstop the European banks with as much money as they need so that Greece can in some way default. Now, you know what they're not going to do? They are not going to call it a default. What they're going to do, my guess, is that they are going to instruct the banks to write down Greek debt to a more realistic level, which would be 40% on outstanding capital. Right now, they've written it down to 20%. So they're going to add 30 or 40% right down to that. Well, in order to do that, the banks clearly need an enormous amount of new capital. 200 billion is the number that's been out there in the media. The trouble with numbers like that is somebody says it once, assumingly from some study that they did of European banks, and then everybody repeats it, but it really is only from one source. And so I don't know the quality of that source, but that's the number that is being repeated. Knowing that it's the European banking system is probably twice that, since they have not been honest or truthful or realistic about any aspect of this problem from the very beginning. Okay, so we have the Europeans preparing to backstop their banking system so it doesn't collapse the world. Okay, that's probably a good idea. I think the Americans would probably like that and everybody else. But if you write down Greek debt on the private side, what does this mean? It's essentially a admission without a de facto, without a de jure admission of Greek default. What does this mean for the European institutions? For the EU, the ECB, the Euro? And this is where I think it gets interesting. The Europeans, in letting the Greeks, in instructing their banks to write down debt, are simply accepting reality. Not that they haven't tried manfully to avoid reality. But in the end, as is almost always the case, reality wins. Hey, Philip, whose haircut are you referring to? Mine? Yeah. Or somebody else? Yes, my haircut is very short, because when you don't have a lot of hair, you get a very short haircut. So yes, that's exactly what the Europeans are going to do. They're going to essentially shave the heads of the holders of Greek debt, and they can all do penance. And that's exactly what should happen. Because after all, if you're going to penalize someone for making a faulty loan, who should it be? The taxpayers who had nothing to do with it, or the people who lent the money? It seems to me far more equitable, and far more capitalist to punish the people who foolishly lent the money. Whatever their assumptions were, they were wrong. Greece is bankrupt and cannot pay back that debt. And the people who should, in my opinion, suffer the losses are the people who lent them the money. If you perform poor analysis, you go bankrupt. and then you start over. At any rate, that is a judgment on my part. Anyway, so if the Greeks default, the Europeans will not be able to call it default because that would trigger all sorts of other write-downs throughout the European Union. The debt of Portugal and Ireland are essentially irrelevant. Although Ireland has said they plan to return to the debt markets next year, Portugal, no chance. Nobody's paying any attention to Portugal, but Portugal is not performing very well on its standard criteria for the bailout functions either. Why? Because their economy is having the same problems that Greece is, although not as severe. But the reason the banks, and let's take a look here. Let's take a look at bonds. Look at your screen. This system that you're looking at is a Bloomberg system. I don't know how many of you have seen it, probably quite a few. It's the reason why the mayor of New York, where I live, is a billionaire many, many, many times over, because this is a system that can do things that no other system can. And you're looking at it. I'm pulling up bond rates. My mic gain, sure. Hang on. Okay. I don't know if that's gain. I'm not very, I'm going to turn up the quality a little bit. Let's see if that's any better. Hope that'll work better. Okay. From Mr. Bloomberg. This is the current trading bond rates in Europe right now, on the 10-year, which is probably the most indicative. Yeah, we can look at CDS in a minute. I'll show you the CDS stuff in a minute. Anyway, this is why Bloomberg is, as I said, a billionaire about 30 times over, because of what this system can do. So these are the rates. Now you can look at the German, say the Italian 10-year right here, or the Spanish 10-year right here, okay? You look down at the Irish 10-year here, and then look down at the Greek 10-year here, and the Portugal. The reason Italy and Spain are where they are, meaning not a lot higher, is because the ECB has been in hand over fist buying Italian and Spanish debt. There is little question in my mind that both of these rates would be over 7%, which the governments have said is unsustainable for their very heavy refinancing needs, if the ECB was not buying the debt. Look at the 2-year. Same thing. Italy and Spain. Greece has been up. Take a look at, let's go back to the 10-year and look at the chart. Okay, watch what else this system can do. This is what, yes, that's right. This is why Bloomberg gets $1,800 a month per terminal. That's right. That's a lot of money. Okay, let's look at the Italian 10-year on a graph. Okay? So can you see that? This graph goes back to February. We could do a daily out to 5 years. All right, it's not worth it. Sometimes, because you're looking at a specific bond, the particular bond doesn't always go back 5 years. At any rate, you have to look at the generics for that, which you can do, but you end up with the same thing, so I'm not going to show you the response to that. But this is the Italian 10-year. This is when they started buying debt, right here, when the ECB started buying Italian and Spanish debt, right here. That decline is ECB purchases. But what has it done? It's gone back up the other way. This is despite ECB purchases through this. Now, of course, if the ECB bought more, they could force it down. So when you are talking about the effect in the markets of what's going on, it's an artificial picture. What the ECB and what the Europeans have done, well, let's put it this way, the markets do not reflect, at least the credit markets, market judgment on what the ECB have been up to. Okay, so let us let that one go. Let me return to some other statistics here. So, for what the ECB is doing, that is one topic. But it's a topic which rises and falls with news out of the EU, like this morning, or over the weekend. The French and the Germans have a plan, and suddenly everybody is perfectly happy to buy equities, to buy risk assets. Now, of course, are they buying risk assets for the long term? Yeah, maybe and maybe not. Most likely, they're simply buying risk assets knowing that the news that has come out of Europe over the weekend will prompt a rally. And so you buy the rally, and then if things turn around, you sell the rally. Nevertheless, you've made some money on it. There are undoubtedly long-term profits out there, certainly in equities. I was listening on the way in to Surveillance, and Richard Bove, who's a very well-known bank analyst, was saying that a number of the major money center banks in the United States, he mentioned, I think, Bank of America and JP Morgan in specific, are priced below their own assets, as if they were not going to make any money, as if it was a liquidation sale. And he was saying that this is a screaming buy. I'm not going to pass judgment on that, but there are options, there are things out there in the markets which, having been beaten down so much by panic, are very viable purchases. Anyway, so this leads us to the second. So it has been this background of varying degrees of panic, or at least concern, made, of course, all the more meaningful by the recent, within everyone's memory, panic in the fall of 2008 connected to Lehman, and the necessary, and the parallels that everyone is making. It's very questionable whether that's the case or not, but that's the way the markets work. That's the way traders work. So we have this fear driving trading, driving markets, driving currency markets as well. You take a look at a dollar chart, the DXY, the euro, almost anything you'd like, and the dollar has been, until the past couple of days, dramatically higher based purely on the desire for U.S. assets. So this fear, and this is the thing I want to talk about, the question we need to ask, because of the difference, now we're just talking about the U.S., there has been a very sort of pronounced disconnect between the sentiment indicators and the statistics. If you look at many of the sentiment indicators, especially consumer sentiment indicators, but also business sentiment indicators to some degree, which are always taken to be the forward-looking indicators. And they are at or very close to contraction levels in many cases. But if you look at the statistics from the economy, they show weak but steady growth. So the question you have to ask is, are the sentiment indicators being colored by the problems in Europe? Are they reflecting a situation which ebbs and flows, but seems, at least in potential, to carry a great deal of worry for the world economy, but none of it is realized yet? After all, the fears of financial collapse or financial system collapse, I'm sorry, I've got to change the TV station in my office because they're showing clips from the Egyptian riots overnight, and it is not conducive to concentration on webinar. So let me change that. So are these sentiment indicators, and we're talking about some of them, I'm going to show them to you right now, are they predictive or reflective? Now, the Friday's, what's today? Today is the 10th. So let's take a look at the 10th. 10/10, North America, the United States. Where is that? Consumer credit. This was, I think, the biggest surprise on Friday was this number right here. Let's take a look at the historicals for consumer sentiment. Look at that. This is the first time in about 18 months, I think, where both the revolving and non-revolving consumer credit decline. Now, if you look back from 2008 and 2009, take a look at this, you can see that September 08, there was an expansion in consumer credit. And after that, the Lehman collapse, look at this run of negative numbers. The height of deleveraging. Consumers were cutting down on they're all losing their jobs, and they were cutting down on their credit expenditures. Then, around October last year, it turned around, and you got a modest expansion. Now, a lot of this is not, well, let's take a look at it. Easier to do it that way, okay? So consumer credit, related in tickers. So revolving is are your credit cards. Non-revolving are term debt. You buy a car, you buy a mobile home, you put a new TV, or a new sound system. You buy it on credit. You don't put it on your credit card. You actually buy it on credit from the store. Those are non-revolving. Student loans go here. This does not include real estate. So if you look at the non-revolving, that's the term. That's, let's say, car purchases and stuff like that. Okay? That has been, from October on, it's largely been that number, which has been positive. And what that means, at least that means to me, is that through the deleveraging period here, consumers did not buy the big ticket items. They didn't buy the car. How long have I been an instructor? Sanders, is that a question directed at me? Well, I've been giving these webinars, I think, for about 4 years. We'd have to ask Maud. I'm not sure how long. I've been a market analyst, at least in public, for about 3 years. Before that, I ran institutional sales here at FX Solutions. Before that, I was chief dealer. But for 15 years, I was a bank trader for Credit Suisse and for Bank of Bermuda in Bermuda. And if you are a bank trader, you perform an analysis role every single day. Because as you walk into work in the morning, the first thing you do So Maud says I've been here longer than she has. I have no comment on that. I will not talk about fashion on this webinar unless Maud agrees to co-host with me. And she would have to participate in the conversation. No, they did not make me wear Bermuda shorts. In fact, no one, in my mind, can wear Bermuda shorts successfully unless they're actually a Bermudian born in Bermuda. And I was not. I was born in New York, so I did not wear Bermuda shorts. At any rate, people can profit in Forex, yes. But trading markets are all difficult. I'm not sure. Okay, that's a good question. I'll address it in a second. Let me just finish my thought on this, and I'll tell you how I think it will trade, how it can help you trade. Okay? If you look at this set of statistics here, it's been largely the term credit that has driven the positive credit since last October. And that, to me, means that people simply put off buying the big ticket items during late 2008 and 2009 because they didn't know where they were going to be. If you look at the revolving credit, you can see that the revolving credit, which is your credit card data, continued to be paid off throughout most of this period and actually resumed back in July and August this year. So the consumer is once again deleveraging. Okay. So that is pretty much of a piece with the consumer sentiment numbers. JP, I haven't forgotten your question. I'll tell you where I go with this. I can't do a lot on it because that's not today's topic, but I will tell you how I think this is useful. Okay, so remembering those revolving credit card numbers, which were weaker throughout the period of this year and last year, and have also turned negative again in July and August this year. So this is consumer sentiment from, I think this is Michigan, University of Michigan. You can see that it topped out back in February at 77, went down to 55, and then came back a little bit in September to 59.4. Let's look at the expectation side of this, which is probably even more telling, okay? This is expectations from the Michigan survey. Again, very similar pattern. High in February, down and remains below the 50 expansion line in August and September, though it has come back a little bit here in September. Okay? That matches the consumer credit numbers. And the reason I bring up the consumer credit numbers is because consumer credit numbers are hard. It's hard data. It's not, as this is, sentiment numbers. Sentiment numbers, they ask you to, the surveys ask you, what do you think of your current situation? How would you rate it? What do you think it will be in 6 months? This kind of data is certainly affected by the overall media picture, the overall news flow of the prior several weeks. So it's certainly possible that consumer sentiment numbers are affected by fears of financial collapse due to what's going on in Europe. The consumer sentiment numbers to me say that these fears are being put into dollars and cents terms. That people are, again, cutting back on purchases. They are deleveraging. They are paying off some of their accounts because they're concerned about this is a different kind of webinar. I don't usually do, but I'll be glad to tell you how I think about it. I really will. This is background. This is the fundamentals of what is affecting your markets. And let me just give you a brief idea of how I think about the trading markets and about currency markets in particular. Most of the time, there is sort of a generalized view, a scenario that's out there that drives the background direction of a market. And here, for the past 3 years, it has been the hoary risk-on, risk-off scenario. So whether or not, and today is a perfect example, whether or not you look at fundamentals on a daily basis, which really haven't changed very much. Europe is probably going to be in a recession the end of this year, the beginning of next year. So why would anyone buy the euro right now? Because that's largely not what's trading. Today, what's trading is the news flow out of Europe, regardless of what the European statistics look like. And the reverse of that is, up until about a week ago, we got a steady diet of bad U.S. statistics. And what was going on? The dollar was going up. So this scenario is very important to trading. And it's very important that you understand it rather than just observe it, because it tells you that the logic is not an economic logic in the markets and has not really been since the fall of 2008. Actually, since the summer of 2008. So that is the idea, and my purpose is to try, or my goal anyway, not my purpose, is to try and help you understand that how the logic, and the logic can change. At some point in the future, the banks are going to start raising rates again, and at that point we'll revert much more to the standard type of logic in the trading markets, in the currencies and the equities, and that is, economy does better, rates are going to start going up at some point, you buy the currency. That's the standard equation in currency markets. The strength or weakness of a currency over time reflects the strength or weakness, growth, decline, rates of growth of an economy. That's sort of the macroeconomic picture you learn in college or in high school or wherever you study, or grad school, I suppose. But we're not in that world, and that world does not seem to be about to return, and today's a perfect example. Okay, so I hope that was a little helpful. This is not a traditional charting or psychology analysis where you look at a currency and try and identify entry and exit points. I can do that as well, but it's not usually what I do for FX Street. They have plenty of people doing that already. I think Derek Fry was on before me, a friend of ours, and that's what he does, and he's very good at it. I do not attempt to duplicate Mr. Fry's presentations or several of the others. An ex-colleague of mine, I believe he's still doing webinars for FX Street, James Chen, who I believe is now at FXDD. He also does that type of webinar. Okay, so we have sentiment indicators. Let's find the conference board one. Predicting quite clearly an unsettled and at the beginning again to retrench consumer. Well, if the consumer retrenches, then everything else starts to follow. You'll get businesses will most assuredly take their cue from this. So this is the conference board, which always scores a little bit lower than the University of Michigan sentiment. So look at this one. Again, same picture. We have now 2 months in a row, 45.20 and 45.40, below the expansion contraction 50% mark, coming down from a high of 72 back in February. So again, the question that's important here is this reflecting economic reality at the consumer level? Or is there a portion of this that is reflecting world news flow and inhibiting an inhibitory effect because of that? It's a question that you can't answer in any definitive fashion. But what you can do is you can look at hard numbers out of the economy and see what they're doing. And when you do that, you have a slightly different picture. Let's try that. Let's use, since we all, I'm sure, paid attention to it, the employment figures from last Friday. Friday was the 7th, correct? So, do these figures, since nothing affects the economy more than consumers' ability to earn income, to spend it, to feel confident that they will be able to retain that income? Well, I'm looking at the Wall Street protesters here I haven't been down there yet. They're encamped directly across from where I used to work at One Liberty when I worked for Credit Suisse. It's an odd story as to why they're there. It's not a city park. It's this concrete park with series of benches, concrete benches. If they were in a city park anywhere in New York City has curfews on the parks. you're not allowed to sleep overnight in the parks, period. The parks all close at 1 o'clock. I haven't been down there yet. I should probably go down there. It's right opposite the trade center. I know exactly where it is. I used to go there and get my jerk chicken from one of the stands there when I worked at Credit Suisse and at Matchbook. Anyway, so just the odd story there. This particular park is a private park. And it has to do with how the land was obtained down there for the park. And the stipulation in this private park, and I don't know who owns it, was that the park had to be open 24 hours. So because it's a private park, and because it is in the mandate for the park, whatever it is, 24 hours, the city cannot go in there and remove the protesters because it's not a city park, which they could do if it was anywhere else. The stories I've heard from some people connected to politics here in the city was that nobody actually knew this, and it just happened by chance that they chose this particular park, and then when the city went to remove them, they found they couldn't. I don't know whether that's true or not. Certainly getting all these protesters to all of these places, even if they're around the country, just New York, somebody's paying for this, so clearly it's being funded, and it's not quite as spontaneous as it appears. Anyway, back to non-farm payrolls. So, non-farm payrolls, I'm sure you're all familiar with this number. We'll take a look at the 1 a.m. generally. Generally, the parks close at 1 a.m. And there's a sign posted in front of every city park. I live in Manhattan. There's a park right down the street from me. So these numbers, let's take a look. These are the numbers we're seeing from non-farm payrolls. I think they open at 6, if I remember, maybe 5, probably 6. Okay, these are the numbers non-farm payrolls. Let's do an average for this year. Okay, we'll go 01, 01, 11. Oh, I hate this. Sometimes it doesn't work. Hang on. It's a great system, but not perfect. Okay, so non-farm payrolls. Historical, see if we can get it from... Okay, so this is from January, okay? So these are the job numbers from this year, first 9 months. The average is 119,000. Now 119,000 is somewhere around stasis level. Economists estimate somewhere between 100 and 150,000 jobs per month are the number of jobs needed to keep the unemployment rate steady. And that is more or less what the economy is creating. So, you look at this, and then you'll say that, well, people who have jobs are not going to take from this a great degree of fear for their own jobs. Now, there may be plenty of fear there based on what's gone on, but right now, the pressures in the economy are not creating mass layoffs. So you can look at this and say, well, perhaps the sentiment numbers, which look so grim looking forward, are reflecting more of the world sentiment, perhaps, fear from Europe, than actual numbers out of the U.S. economy. You can make that case. Here's another one. Let's look at manufacturing payrolls. Now, manufacturing payrolls, I'm not going to be able to come to a conclusion on this. You understand that, because it's pulling in two different directions. Manufacturing payroll. Now, the reason people have looked at manufacturing payrolls for years, both in manufacturing ISM and in payrolls, is because the idea is that the manufacturing sector leads the economy. So this, in fact, is used as a forward-looking sentiment indicator, just like the Conference Board, just like some of the Fed surveys, just like the ISM to some degree. And what do we see here? Here we see the other side of it. Here we see manufacturing starting to lose jobs again in August and September. What does this reflect? This identically reflects the consumer credit numbers. Revolving credits started to get paid off again in July and August. Or was it August and September? I think it was August and September. Just like this one. So, are those sentiment numbers reflecting this reality? The manufacturing, the leading indicator for the job numbers? Or are they reflecting sentiment and ignoring the reality of the 119,000 jobs per month every month this year? Question you can't really settle until you see the coming data. We're not going to deal with the unemployment rate because the unemployment rate study, and in my mind, the unemployment rate is a false statistic because it only reflects people who say they're looking for jobs, and that is not an economic reality. If people can't find jobs and have stopped looking, then their economic contribution to the economy, which is what we're really talking about, because if you have a job, you spend, you contribute to the economy. That if you stop looking, then you can't contribute to the economy. So using someone says, I'm not looking for a job anymore, doesn't mean that they have found a gold mine someplace and are monetizing that gold and still buying things. No, it really means that their unemployment rate, that their contribution to the economy continues to be very, very low or negative. I've said this a number of times before. If the unemployment rate, if the number of people looking for jobs had stayed steady for the past year and a half, that unemployment rate would be somewhere north of 10%, close to 11%. So this in my mind, is a false number. The unemployment rate, the U6 number, that's the number which includes people who have stopped looking for a job and people who are part-time but can't get full-time. Let's take a look at this one. This is not a comforting number. This has much more is much more close to the manufacturing jobs that we just looked at. And here you go. This was up at 17.1 a year ago exactly. It moved all the way down to 15.8 in May. And it has now climbed back to 16.5%. There's another uncomfortable statistic I'll show you. I have to find it. It's the Challenger job numbers. I think it came out last Friday. Yeah, here we are. Challenger job cuts. Now, what this measures is the number of announced layoffs as a percentage. So if you have 3 and the next month you have 6, this number would be 50%. So again, look at these numbers. It rises before you get a real collapse in employment. Take a look at these numbers. Okay, this is now going back to 08. It starts rising in 08, in the beginning of 08. Now, we're already in a recession, according to one of the measures. So it starts rising in 08. It keeps rising throughout 08 and 09, and then it starts to fall again. Because simply the announcements for layoffs are all here. These are announcements. Bank of America said this, and some others said, we're going to start layoffs, in 2 months, we're going to lay off 30,000. It's that announcement which is recorded here. Yes, Sanders, you're absolutely right about that. That's true. Remember, the government is not in favor of recording, because it makes all the politicians look bad and the government's policies look bad, high unemployment numbers. So they have, frankly, screwed around with the statistics to give it sort of the best cast they possibly can. I remember reading someplace that if unemployment the criteria were the same as they were back in Carter's presidency about 30 years ago, then the unemployment rate today would be somewhere around 12%. I can't vouch for the veracity of that, but I have read that. Okay, so what we're looking at here, yes, in many places I think that's true, and I do think that's why I don't really pay much attention to the regular unemployment rate. I look at the U6 rate because that really reflects what's going on in the economy. people can't find a job for 6 months and they give up looking. I'm sorry, but they're still unemployed. And their effect on, it's called the U6 rate. If you're interested in this, go to the Bureau of Labor Statistics, fish around in their website, and they will send you once a month what's called the Employment Situation Report, and that is the actual title of the report, which we call the Non-Farm Payroll Report. And all these statistics will be right there. It's about a 40-page report. They'll send it to you an email. They're very efficient. They send it out about 10 minutes, if I remember, about 10 minutes after the numbers are actually released. You're going to have all these numbers. And you'll be surprised how much data the government collects. Anyway, so I'm going to have to stop pretty soon, but I will give a summary here. I hope this has been useful. I do these once a month for FX Street. I may, in a month or two, be moving to 2 a month, but we'll talk about that with the FX Street people. Anyway, so Challenger layoffs. As you can see, all throughout 2009, this is a genuine leading indicator because it tells you what companies are planning to do. It's just, and it's not sentiment. It's announced layoffs. There is no exact, that is correct. There is no exact science to Forex. Forex is a trading market. Trading markets are the art of the finance world. They are not science. It can be a profitable business for traders, but trading is a very individual skill. And it can be. I mean, I was a profitable trader on the bank side. It can be. But it is a difficult business, and it involves a lot of self-control, shall we say. I have on occasion given webinars on psychology. I suppose I'd be glad to do that again. I haven't done one in a while. Okay. So let me just finish this because I know Maud is going to let me know that I have to stop. So look at these numbers. This is a genuine leading indicator. These are announced layoffs. Look what's happened in July, August, and September. The number of layoffs that are being announced by businesses is skyrocketing. It seems to me that there is some reality to the fall in sentiment numbers on the consumer side. That the harder numbers that are showing a slow growth economy can be questioned. Because, and this is the crux of the argument about the U.S. economy right now. Because even growing at 1.5 or 2%, that's such a slow growth that almost any shock could push it into recession. And this is the kind of shock that is potential. For 3 months, you have rising announcements of layoffs. I have done some in the past. I'd have to discuss them with the folks at FX Streets, but I have done some webinars on trading psychology, yes. I find it fascinating, actually. Markets are far more psychology than they are anything else. My favorite quote of all the market cliches is the market can stay illogical far longer than you can stay liquid. And what that means is you better pay attention to what the market's fears and hopes are, because that is going to dominate trading. And this is something which is very, very pertinent now, because we have not, as I said earlier, we are not trading the macro equations these days. Not in equities, somewhat in commodities, but certainly not in Forex. We're trading fears. We're trading the risk equation. And that's been true for 2.5 years now. Okay, so I will have to end here. So we have this split in the statistics in the United States, and I'm only focusing on the United States. Right now, whether or not the economy will maintain its 1.5 or 2% growth, whatever it is, over the next, well, we're now into the fourth quarter and into next year, and whether the sentiment indicators are reflecting fears, and perhaps irrational fears, or at least not realized fears, for the world financial system and the world economy because they're based on Europe, or there is some reality to consumers' concerns and hesitancy. And if you're going to connect American consumers' concerns and hesitancy to anything, it would be to the job picture, to the ability to find work, to the concern about losing your own job. And there are, I think, enough numbers, particularly this one right here, the Challenger numbers, to give reality to the fall in consumer sentiment. And if that's the case, then it would seem to me that sooner or later, over the next 6 months or a year, there will be some event. You can't skate so close to the edge. When the ice, I'm really going to work this metaphor to death. When the ice is as weak as it is and not fall in at some point. Okay, folks, I hope this has been useful. I do apologize that this was not directly connected to, entry and exit points. I haven't done one of those kind of webinars in a while, and I don't think that's really what FX Street is interested in. However, I will type in my email address. Please feel free to contact me on any topic that you like. And once again, I thank the FX Street folks, Maud and Alinda in particular, for putting on this webinar. I believe they tape them and offer it out to the world electronic media, but you'll have to ask them about that. Take care, everyone, and lots of luck trading. Bye-bye.